At the height of Enron's power, their shares were a symbol of unmatched success, trading at an astonishing $90.75. Fast forward to the brink of their collapse, and the picture dramatically shifts. These same shares plummeted to a meager 26 cents amidst bankruptcy proceedings. So, how did we get here? How did a titan of the energy world crumble so spectacularly? This isn't just a story of numbers and finance. It's a tale woven with ambition, innovation, and the perilous cliff of ethical shortcuts. Enron, once the darling of Wall Street, embarked on a journey marked by rapid expansion and groundbreaking ventures in energy trading and beyond. But beneath this sheen of success, there lurked a complex web of deceit. As we peel back the layers of this corporate giant, we find a narrative riddled with fraudulent accounting practices, hidden debts, and a toxic corporate culture that championed profit over integrity. We will journey through the rise and fall of Enron. From its ambitious beginnings to its catastrophic end, we will uncover the decisions and actions that led to one of the most infamous collapses in corporate history. Join us as we unravel the Enron saga, understanding not just the how and what, but diving deep into the why. It's a story that reshaped the financial world and left an indelible mark on corporate governance and ethics. Welcome to the Enron story, a cautionary tale of greed, ambition, and the consequences of losing sight of the moral compass. Before we get started, I would like to give a shout out to Bet McSheffrey. You're doing great things for this channel, and we enjoy having you here. Now let's get to the video. Origins. In 1985, Houston Natural Gas and InterNorth merged to create a new entity called Enron. This marked the entrance of our first major player, Mr. Kenneth Lay. Mr. Lay, previously the Chief Executive Officer, CEO of Houston Natural Gas, assumed the roles of Enron's CEO and Chairman. One of Lay's initial moves was to transform Enron into an energy trader and supplier. With energy markets being deregulated at that time, companies had the opportunity to speculate on future prices, and Enron seized this opportunity. In 1990, Lay established Enron Finance, coinciding with the arrival of our second key figure, Jeffrey Skilling. Skilling, formerly a consultant and one of the youngest partners at McKinsey & Co., brought a new dynamic to the company. The minimal regulatory environment of the era played a significant role in Enron's success. As the 1990s drew to a close, the dot-com bubble was reaching its peak, and the NASDAQ hit an astonishing 5,000. Revolutionary internet stocks were valued at astronomical levels, leading most investors and regulators to accept the surging share prices as the new normal. To market, MTM Accounting is a method created by Skilling and approved by the U.S. Securities and Exchange Commission in 1992. It allows companies to change the value of their assets on the balance sheet from the original cost to their current market value. This means companies can estimate income based on the expected future cash flow. For example, if a company signs a contract worth $100 million over 10 years, MTM Accounting lets it record $100 million as income immediately, regardless of the actual outcome of the deal. This method enabled Enron to appear more valuable in its financial statements than it really was, hiding the true state of its business performance. Some believe that this was the beginning of the end for Enron, as it essentially permitted the organization to log estimated profits as actual profits. Enron Online. In October 1999, Enron launched Enron Online, EEL, an online platform for trading commodities. Enron acted as the main party in every transaction on EOL, either buying or selling. The company attracted participants and trading partners by leveraging its reputation, creditworthiness, and expertise in the energy sector. Enron's growth and bold projects earned widespread acclaim, and it was recognized as America's most innovative company by Fortune magazine for 6 straight years, from 1996 to 2001. Blockbuster. From the late 1980s to the mid-2000s, Blockbuster reigned as a video rental chain juggernaut. In July of 2000, they formed a pivotal partnership with Enron Broadband Services, venturing together into the burgeoning video-on-demand market. Enron Capitalizing on this new venture, didn't waste any time using mark-to-market MTM Accounting to log the expected earnings. This approach was based on the anticipated growth of the VOD market, leading to a significant inflation of their financial figures. By mid-2000s, Enron Online, EOL, was executing trades nearing a staggering $350 billion. However, as the dot-com bubble began to burst, Enron's expenditures did not wane. They embarked on building telecom high-speed broadband networks, investing hundreds of millions of dollars. Despite the massive spending, the returns were minimal, and Enron started hemorrhaging money globally. The company's next endeavor was constructing a power plant in India. This project, too, faced dire straits when they realized India was unable to afford the electricity. Abandoning the project, Enron left it in ruins, suffering a loss of billions in the process. Nonetheless, this setback didn't deter the executives from documenting future profits for the project in their accounts, awarding themselves massive bonuses in the process. With financial strains mounting, Enron turned to a novel project, trading weather futures. In essence, they speculated on temperature fluctuations, a venture akin to gambling. Amidst these ventures, only a few key individuals were aware of the company's deteriorating financial state. Despite this, Enron's manipulated books painted a picture of profitability, earning them a spot on Fortune 500's list of the most innovative companies. Darling crumbles. As Enron's financial crisis deepened, the company found itself in increasingly dire straits. CEO Jeffrey Skilling persisted in employing mark-to-market MTM accounting, a strategy that obscured the company's escalating losses and falsely portrayed it as more profitable than it actually was. Faced with soaring liabilities, Enron turned to Andrew Fastow, an ambitious executive rapidly climbing the corporate ladder, who soon assumed the role of Chief Financial Officer, CFO. Fastow crafted a meticulous strategy to project an image of financial stability, despite the fact that numerous subsidiaries were bleeding money. This deceptive financial engineering was designed to maintain investor confidence and artificially inflate the company's stock value and hidden debt. How did Fastow and his associates at Enron conceal their massive debt? They devised a complex scheme involving off-balance sheet special purpose vehicles, PVs, also known as special purpose entities, SPEs. These vehicles served a crucial, albeit deceptive, role in hiding Enron's burgeoning debt and toxic assets from investors and creditors. Their primary goal was to obscure accounting realities rather than to mask actual operational results. This intricate financial maneuvering was designed to create an illusion of financial health, misleading stakeholders about the company's true fiscal state. Arthur Andersen. In the web of the Enron scandal, another key figure was the company's accounting firm, Arthur Andersen LLP, particularly partner David B. Duncan. These individuals were responsible for overseeing Enron's financial accounts. At the time, Arthur Andersen is one of the 5 largest accounting firms in the United States, was renowned for its high standards and robust risk management. Despite this reputation, and in the face of Enron's dubious accounting practices, Arthur Andersen endorsed the energy company's financial reports, providing their stamp of approval for years. This endorsement came despite glaring issues in Enron's financial management and reporting. By April 2001, skepticism began to emerge in the financial community. A growing number of analysts started raising concerns about Enron's earnings and the transparency of its financial disclosures, hinting at the troubles that lay beneath the surface. California blackout. Faced with a growing need for more capital, Enron turned its attention to California. The company merged with Pacific Gas and Electric Company, gaining access to California's electrical grid. With the deregulation of the electricity market, rolling blackouts became a frequent occurrence in the state. Curiously, these blackouts happened despite California having more electricity supply than demand. What was the cause? It was later uncovered that Enron traders were actively manipulating the electricity market. They strategically moved electricity out of California to create artificial demand. Once prices skyrocketed, they would bring the electricity back, profiting from the inflated prices. In a more blatant manipulation, These traders would contact power plants, urging them to fabricate reasons for shutting down temporarily, further spiking electricity prices. With comprehensive energy maps and control systems at their disposal, the traders could maneuver energy as they pleased. While Californians grappled with exorbitant electricity bills and disruptive blackouts, Enron's staff reveled in substantial bonuses. Why didn't the state intervene? Legally, the responsibility fell on the federal government. However, Californians faced a significant hurdle. The then president, George W. Bush, was a close ally of Enron's CEO, Kenneth Lay. Adhering to his administration's belief in non-intervention, Bush refrained from stepping in, arguing that federal involvement wouldn't resolve the crisis. It wasn't until the Senate applied pressure that the Federal Energy Regulatory Commission finally took action. By the time the dust settled, Californians had incurred losses exceeding $30 billion. Game over. In 2001, with no prior indication, Jeffrey Skilling abruptly resigned as Enron's CEO, and Kenneth Lay stepped in to fill the role. The very next day, Sharon Watkins, an employee under CFO Andrew Fastow, sent a detailed letter to Lay exposing the rampant fraud and corruption she had discovered within the company. The Wall Street Journal soon published an article highlighting some of the fraudulent activities involving Fastow, capturing the attention of the SEC and triggering an informal investigation. As uncertainty and concern grew among investors and employees, Lay sought to allay their fears with reassuring speeches. However, in a stark contrast just blocks away, Enron's accounting firm, Arthur Andersen, was frantically shredding documents in a futile attempt to cover up their involvement. But time was running out for Enron. Within a month, the company shifted from an energy titan to bankruptcy. The stock market was in turmoil. Enron's shares plunged from $32 to a mere $9 when trading resumed. Enron executives hastily liquidated their stocks in a desperate fire sale. As the scandal escalated, criminal investigations ensued. Cliff Baxter, a close associate of Skilling, who had cashed in $30 million from Enron, tragically took his own life after being summoned to testify in court. Andrew Fastow, the former CFO, pleaded guilty to conspiracy to commit wire fraud and agreed to testify against other executives in exchange for a reduced sentence. He was initially sentenced to 10 years, but ended up serving only 6, alongside a fine of $23 million. Arthur Andersen, the firm implicated in document shredding, was found guilty of obstructing justice and subsequently collapsed, resulting in the loss of 29,000 jobs. Ken Lay, convicted on 10 counts of securities fraud, faced a 45-year prison sentence, but died of a heart attack before his sentencing. Jeffrey Skilling, identified as the mastermind behind Enron's fraudulent schemes, was convicted of 19 counts of securities and wire fraud, sentenced to 24 years and fined $180 million. Tragically, while serving his sentence, he lost his parents and son. Skilling was released in early 2019 after serving 12 years. In the wake of Enron's collapse, 20,000 employees lost their jobs and insurance, with an average severance pay of only $4,500. Contrastingly, Enron executives received $55 million during the bankruptcy proceedings. The Enron scandal stands as a stark reminder of the devastating consequences of corporate malfeasance. This saga of greed, deception, and betrayal not only led to the collapse of one of America's largest energy companies, but also caused irreparable damage to thousands of lives. The fallout from Enron's unscrupulous actions rippled through the global financial community, shattering investor confidence and leading to significant reforms in corporate governance and accounting practices. The demise of Arthur Andersen, once a paragon in the accounting world, and the tragic personal losses experienced by those entangled in the scandal underscore the far-reaching impact of unethical corporate behavior. Enron's story is a cautionary tale about the importance of transparency, integrity, and accountability in the business world, serving as a reminder that the pursuit of profit should never overshadow basic ethical principles.